bring on our guest, Tim Quast, founder of Market Structure Edge. Tim, how are we doing this morning?
Great. Good to see you guys. Greetings from chilly Steamboat Springs, about 2 below zero here today. How are things where you are?
Not that cold.
About the same. I'm cold too.
we had a heat wave this weekend. We got up close to 50.
Yeah.
Wow.
Yep.
Wow. How about that? Well,
How about this market, Tim?
well, I was listening to your conversation about Cathie Wood and Palantir, and it reminds me, pardon me for 1 second here.
I'm sorry, you're getting choked up talking about Cathie. We get it.
It's
We all do.
We all do, Tim.
that's my statement on the market right there. But seriously, there is the problem to me with much of what you hear from punditry is that the market moves for rational reasons, and you look at Palantir and you look at the size of passive money and what was happening last week. I think it's one of the most important concepts that trillions of dollars has to figure out how to get itself pegged back to the benchmark around the last trading day of every month. In 2014, the CBOE, Chicago Board Options Exchange, created a futures contract that helps passive money get itself realigned. And if you've had tremendous volatility, a tug of war will develop between the banks that supply those contracts so that folks like Cathie Wood don't have to do it all themselves, and the funds that will be in trouble if they have tracking errors. And so everybody's talking about interest rates and the reopen trade and this thing and that thing, and overlooked almost entirely is this massive wave that occurs at the ends of each month. And it happened this past week. It happened at the transition from January to February. Remember, January concluded brutally, and February began with a huge surge. So if you get yourself realigned with the index about the same time that a bunch of money floods into target date funds and 401k contributions and that sort of thing, you can see that stuff coming. And I'm surprised at how few people pay attention to it. So and Palantir is a great example. Palantir was peaked. It was overbought when everybody was talking about Cathie Wood buying Palantir. If you look at it now, it's 1 out of 10.
Whoa.
1 out of 10 oversold, and it's dropped from 50 to 29% short. So if I were looking at that, I would say, okay, everybody who was out of whack with Palantir surges, and it becomes an especially large part of your index composition, then it's going to have to get trued up. But that also creates an opportunity, I think, to buy it. And it would be a very contrarian thing to do if you look at the chart. But if you look at market structure, after all, it is Market Structure Monday, the story may be entirely different. And I'm happy to show you.
So when these get down to a 1, they're just so oversold that they're due for a pop. Is that what it's kind of saying? Or when it's down to a 1, do those just continue to be out of favor?
Right. And Tesla is a great example of that. So Tesla is a 1 as well. But if you look at the data, you don't want to buy Tesla when it's a 1. You want to buy it when it ticks up from 1. That's when it starts
getting some
exactly
life. When it starts showing life.
Right, and you know what? And for those of you who have never heard me yammer on here on Market Structure Monday, what we're talking about is supply and demand. So at Market Structure Edge, we really don't care about interest rates or Federal Reserve. We track all that. I mean, I track the fact that the Fed is buying $200 billion of mortgage-backed securities every month? Well, sure. It's going to drive down the rates for mortgages. It's going to make borrowing money very attractive, but it's not the core of what we focus on. What we're concerned about is supply and demand. And when demand has peaked and begins to recede, stocks are going to decline. And when sentiment bottoms and people have to begin to put money back to work, stocks are going to rise. And it is that simple to me.
So Tim, let's talk what else is on your radar here. Obviously, we see some of the mega caps, some tech out of favor. I mean, a lot of stocks were out of favor last week. It was a hammer 'em all Friday close where they were selling everything here. Do you think, let's just go overall market first of all? I mean, we've had a little bit of the air come out of the bubble to a certain extent. Some stocks that weren't even, in a bubble got hit last week. Do you think there's some opportunity to come here and buy the dip, or do you think there's more pain ahead?
Right, well, so what's the word I'm looking for? I don't want to be arrogant and say, to quote myself,
yeah.
But we had this conversation last week. I said last week on Market Structure Monday, GameStop was a pretty good trade. Looking at it, it was 1 out of 10, 40% short.
Yeah,
I traded it this week. I made 10% in an hour on it. It's not really my kind of trading, but I knew that the probability would be on my side. If the math is in your favor, then take advantage of it. But the broad market, remember, we were looking at the broad market, and I said, this is not the time to be in the market. And I joked that, if you're hearing Maxine Waters talking about market structure, you should be in cash. But I was looking at supply and demand and saying that the math was not in our favor, and I expected tumult into the end of the month. And we're not there yet. However, because money flows in at the beginnings of new months, you never know. I will not be surprised if the market rises sharply today, and then maybe Tuesday or Wednesday, the bottom falls out again. I'll show you why, too. So if you like, let me just show you this. I think it's a useful thing to see. And folks, if you're following along, go to Market Structure Edge. And you can do the very same thing. You sign up for a free trial, so you don't have to put a credit card in or anything. And you can see this. You can see the same thing that I'm showing you. So I think if you see my screen here, this is how we see the world. And what you're looking at is this period from about the 14th of January. It's a 30 trading day period. So this very non-volatile line is market structure sentiment. The volatile line is SPY. And isn't it interesting that the VIX hit a 52-week low on February 12th at the same time that SPY hit a 52-week high, and sentiment rose over 6. So we say when the market is above that red line, danger increases. When you're near the green line, there is opportunity. And so look where we are. I would look at that and say, well, there's a chance because it happened back here. As we transitioned from January to February, the market surged and sentiment was still falling. So can prices be quicker than sentiment? Well, yes, they can, particularly because of this index effect of trillions of dollars getting rebalanced, money coming back into the market. Could that happen again? Yes, but I still would be very cautious until that line changes direction. That's how we think about it. And again, that's supply and demand. It doesn't have anything to do with Fed policy or headlines or fundamentals. It has to do with the supply and demand in the marketplace.
Tim, out of curiosity here, can you maybe pull up a GameStop? I just want to see what it's done in the last week.
Right. So here's GameStop right down here. And so the things that we will look at, here's sentiment, and the trend is up, but it's 58% short. And the lead behavior is Citadel and Quant Labs and Hudson River Trading and so on. So they're much, much faster than you. So you have to be careful. This is how you'd look at it. Where do you want to be in and where do you want to be out? Sentiment and price. So if it's bouncing against the ceiling at 10, well, that's really good. I can't tell you that you could perfectly capture these moves, but when sentiment rises, that's where you buy. And when short volume is very low, there's the short squeeze that we talked about. It really didn't happen until right into the end of the month. But then when short volume rises above the trend line and sentiment's at 10, leave. And then don't come back until it begins to tick up again and short volume has it's been covered. This is where you're going to have mathematical opportunity. But look at it now. Sentiment is still rising, but short volume is back to almost 60%. And so I think that trade is about to run out of steam again. Here was your very brief opportunity to make money, and I would be cautious because of the high short volume. But that's how we look at it.
Tim, I like to make this one comment here on GameStop. Yeah. Can you say a lower high? I mean, look at the pop that it had. I mean, if you're, if you think, like, I know that some people are buying 800-900 calls or whatever, and they're looking for 250, 300. If there's anything that you need to pay attention to when a stock has a dip like that and then attempts to rebound, look where, like right now, I mean, when it got up to 200 in the pre-market, and I mean, can you say lower high? I mean, and I don't know what if it could take news, but just from a pure technical standpoint, man, a much, 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 much lower high.
Yep. Well, in that same vein, let's look at Palantir here. So where should you have been out of Palantir? Well, when short volume was 60%, and it's 10 out of 10, even though you might miss this little bounce, which may be the Cathie Wood effect, that data is telling you leave and don't come back until it ticks up. But look where it is now. Short volume is very low. It's well below the trend. It's a 1. And when it ticks up, that's when you want to be a buyer. And that's going to happen here, I would say. We're within 2-3 days of that happening. And then Palantir is going to present some good opportunity. But again, this is supply and demand. It doesn't have anything to do with Palantir's results or its prospects or its competitive advantages. It's purely supply and demand.
Yeah, I mean, but there's a lot of traders, like you look at this and they don't want to know the fundamentals. They don't want to do that. And that's fine. I mean, there's like lots of great technical trading systems. And, if you believe somewhat in the efficient market hypothesis, some of that should be incorporated into the price. And then, so you look at the price action, you do get that indirectly.
Right. So, and, you could go right down the line here. Tesla, bottomed, 45% short. Passive money is the lead behavior. A lot of passive money has to own Tesla. So I'm going to be looking at that. I know mathematically, here's the thing. This is really an interesting way to think about the math. If I come up, we have this is a back testing engine. So if I put Tesla in and say, what happens if I buy the uptick here? And I'm just going to look at that data historically. Well, that data would give me an 83% return, which is better than buying and holding Tesla. It crushes the S&P 500, and I did it in 60 days. So am I buying the uptick in Tesla? Yes, I am. And it's getting very, very close to that. So that's how I think about it.
And what do you buy when it gets to a 2 or a 3, like just as soon as it starts ticking up from 1?
First uptick from 1. Yeah, mathematically, that has been a very good trade.
I know we don't want to give away your secret formula here, but what causes it to go from 1 to 2? Like, what is like the main driver that's going to be causing it to tick up?
Well, so it gets to one of our core principles that price and volume are not metrics. They are consequences of activity beneath them. So our calculation of market structure sentiment says there are 4 reasons people buy and sell, not 1. If you look at the stock market and say people are investing, you will only be partly correct, right? But there is investment behavior, but active investment behavior, stock picking. So Tilray is being led right now by active stock picking. Well, that's 9% of market volume. 91% of it is passive, fast trading, or risk management. So we compile how those behaviors change and what effect they have on price. So if fast trading is 54% of trading in GameStop and it rises by 15%, GameStop is gonna move. And that's what we calculate here. And when it stops, what happens if the machines all of a sudden vanish? Well, we're gonna see that. And that's how the market really works. There are people who buy stocks for their unique characteristics, that's stock picking. There's way more assets now buy stocks for their shared characteristics, their market cap, their exposure to an industry, their volatility characteristics. Then there are machines like Citadel, Virtu that are intermediating the market. Well, that's a huge part of the market, and they don't want to own anything at the end of the day. So you can't look at them the same way you would look at an S&P 500 fund that has to get all of the components of the index properly balanced in its holdings. And then risk management, the use of derivatives, that's 18% of the market. So if there's a big change in demand for derivatives, that's going to have an effect. But that's what goes into market structure sentiment. So makes it very simple. You don't have to know all that stuff. All you have to do is follow a scale from 1 to 10. And that's the point here. And look, I'm not selling edge. I'm just saying that these things are so profoundly applicable to the marketplace that traders necessarily have to think about them now. 1995, you didn't need to do that.
Tim, just one more before I let you go.
You betcha.
On the FANG stocks, right?
Yes.
Let's talk about that, because they've done a whole lot of nothing.
Right.
For a hot minute here.
Right.
So how do you approach that?
Here's how we by the way, we just default to providing a FANGs Plus portfolio to folks who use Edge. So it's gonna be there as a matter of course. But just look at this. If you focus only on the trend, so there are a handful that are bottomed. So AMD, Apple, Netflix, Tesla, all bottomed. Short volumes look very appealing. Levels below 50% are very appealing. But look how many of them are still trending down. So as a group, we are not there yet. And you can really see that just looking at the broad portfolio, the FANG, and I'll show you here. If you just want to look at the trend line, and I think very much about sentiment as a trend, and it's a 10-day cycle roughly. So look at this. Here's where they peaked. And it perfectly coincided with the top for the S&P 500. February 12th, 52-week low for the VIX, 52-week high for SPY, and the FANGs peaked. So look at the trend line. It's still coming down. Short volume looks really good. See, they were heavily short in here. Now that short volume has come back in line with the trend. When this line ticks up, we are back in business. How far is that away? It's within a week. So within a week, I think we see the market move. I don't think the market is in trouble yet. At some point it will be, but I don't think it's going to be February 2021. But you want to make sure that you capture the wave and you don't get washed over by it, so to speak.
All right, Tim Quast is the founder and CEO of Market Structure Edge. Joins us every Monday for Market Structure Monday. Tim, as always, we appreciate the time. Thanks a lot.
Good to see you guys.